SEBI announced several significant reforms across asset classes and introduced a new regulatory approach. These reforms include measures for small and medium enterprises, SME, initial public offerings, IPOs, performance validation mechanisms, and a regulation mandating public consultation in its decision-making processes. Below are 9 key changes from the 19 announced, along with one regulation that was not approved, bringing relief to many market participants. SEBI has introduced tighter regulations for SME IPOs focusing on financial performance, corporate governance, and promoter contribution. Key changes include issuers must have a minimum operating profit, EBITDA, of 1 crore rupees in at least 2 of the previous 3 financial years. Related party transaction norms, previously applicable only to main board entities, will now extend to SMEs. Funds raised for general corporate purposes are capped at 15% of the total or 10 crore rupees, whichever is lower. IPOs aimed at repaying loans to promoters or related parties are prohibited. Excess promoter contributions beyond the minimum required must be locked in for 1 to 2 years in a phased manner. SEBI announced the creation of the Past Risk and Return Verification Agency to validate risk-return metrics for research analysts, investment advisors, and algorithmic trading providers. While voluntary, this service will initially roll out as a pilot. A credit rating agency will act as the Past Risk and Return Verification Agency, supported by a stock exchange serving as the data center. The regulator raised net worth requirements for merchant bankers. Category 1 must have a minimum net worth of 50 crore rupees and can undertake all activities. Category 2 must have a minimum net worth of 10 crore rupees and is restricted from managing main board issues. Merchant bankers must also separate SEBI permitted activities from other business operations under distinct legal entities within 2 years, though resource sharing on an arm's length basis is allowed. SEBI added 17 more events to the definition of unpublished price-sensitive information under the insider trading regulations, aligning it with the listing obligations and disclosure requirements regulations. Companies now have up to 2 days to log UPSI related to external events and are no longer mandated to enforce trading window closures in these cases. A new regulation codifies the public consultation process. Any policy or regulatory change must be open to public feedback for at least 21 days, with justifications for adopted policies made public. SEBI eased skin in the game requirements for mutual fund employees, reducing minimum investment amounts and lock-in periods for resigned employees. For new fund offers, asset management companies must deploy collected funds within 30 days, promoting efficient fund utilization. Real estate investment trusts and infrastructure investment trusts can now invest in unlisted equity shares of companies providing ancillary services, such as property management. Investments in liquid mutual funds are also permitted, provided they meet stringent credit risk criteria. SEBI also introduced measures to ease compliance for small and medium REITs. The threshold for high-value debt-listed entities has been increased from 500 crore rupees to 1,000 crore rupees, aligning with thresholds for large corporates. Material related party transactions in entities with concentrated related party shareholding will require a no-objection certificate from debenture trustees, backed by debenture holders' approval. SEBI emphasized that entities using artificial intelligence tools, whether in-house or from third parties, are responsible for data privacy, security, and tool outcomes. This applies to market infrastructure institutions, asset managers, and other SEBI-regulated entities. SEBI did not approve the contentious prohibition of unexplained suspicious trading activities regulations, which would have placed the burden of proof on individuals or entities engaged in suspicious trading. While SEBI argued this aligns with global norms and addresses evidence manipulation risks, critics claimed it violated natural justice principles. These reforms mark a significant shift in SEBI's regulatory approach, balancing stricter oversight with enhanced stakeholder engagement.